Welcome to The Explainer. I am absolutely thrilled you're tuning in today because we are stepping into the ring for what I genuinely like to call the ultimate financial heavyweight bout. We're looking at two massive investment vehicles that are constantly going head-to-head. It's paper assets taking on physical properties. And honestly, with how fast markets are changing and inflation just constantly shifting the ground beneath us, this debate is more relevant right now than it's ever been. So we're going to break down exactly how these two powerhouses work side by side.
Getting into this topic starts with a question we've literally all asked ourselves late at night. Where do I actually put my money? What's a genuinely good investment? And more importantly, is my money going to be safe? Trying to figure out what to choose can feel completely overwhelming. It kind of feels like you're leaving money on the table if you make the wrong call, right? Well, that's exactly why we're here today, to cut through all that noise, look at the actual mechanics, and empower you with the facts.
Here's our roadmap for today. We'll start with the investor's dilemma. Meet the contenders, weigh risk versus reward, dive into liquidity and mechanics, tackle the tax angle, and finally, help you make your choice.
All right, Section 1, meet the contenders. Let's define mutual funds and REITs.
In one corner, we have mutual funds. Basically, these are institutions that pool together capital from a massive network of investors. They take that money and deploy it into a highly diversified portfolio. We're talking stocks, bonds, the whole shebang. Instead of you trying to pick one winning company, you're effectively buying a tiny slice of the broader market. It's really the ultimate strategy for spreading out your bets and just trusting in overall market growth over time.
And in the other corner, we have REITs, which stands for Real Estate Investment Trusts. These are institutions that own, operate, and manage major wealth-building properties. And we are talking massive scale here. Multi-million-dollar commercial buildings, sprawling apartment complexes, high-end hotels. These are assets the average person could literally never buy on their own. The genius of a REIT is that it lets you invest in these massive real estate projects and actually reap the benefits without having to buy or manage the building yourself.
To put that into perspective, take a look at how a typical REIT is structured. Usually, a whopping 80% of their portfolio is anchored in established rent-generating properties. By doing this, REITs build this foundation of highly reliable, consistent income. The remaining 20%? That's dedicated to under-construction properties, which is where they aggressively chase future growth. It's this really fascinating balancing act between rock-solid stability and strategic expansion.
Subhash Goyal, the MD over at Goyal Ganga Developments, really hit the nail on the head here. He points out that the key particularity between mutual funds and real estate is, well, simply the type of assets they invest in. It all comes down to focus. Mutual funds are highly diversified across totally unrelated markets to cast a wide net. REITs, on the other hand, are hyper-focused. They invest exclusively in the real estate market to capture that localized physical asset growth.
Moving on to Section 2, risk versus reward. We're going to look at historical returns and economic risks.
Now, the raw numbers here are wild. According to research by the National Association of Real Estate Investment Trusts, or NAREIT, real estate returns historically jumped from 16.5% back in 2000 to an absolutely massive 39.9% in 2021. Compare that to mutual funds, which have historically yielded peak returns of around 12 to 15%. That insane 39.9% spike in real estate is exactly why so many investors are drawn to the sheer upside of physical property.
But hey, returns are only half the story, right? We have to talk about safety. Resource specialist Siddharth Maurya puts the mutual fund strategy perfectly. The explicit motto is to maximize returns by minimizing risk. Because fund managers don't want to risk all your money on a single share or sector, they create a highly diversified portfolio of entirely different stocks. So while investing always carries some risk, over the long term, that broad diversification minimizes potential losses to a massive extent.
REITs, however, carry a completely different risk profile. They can actually become highly vulnerable during an economic slowdown. Think about it. If the broader economy stalls out and commercial spaces empty out, property prices might actually depreciate instead of appreciate. So the crucial takeaway here is that while mutual funds have that built-in diversification to minimize long-term risk, REITs are tied directly to the health of the real estate sector with no long-term guarantee.
Which brings us to Section 3, liquidity and mechanics. Let's talk about how to actually buy in and cash out.
Fundamentally, REITs and mutual funds are structurally pretty similar, as Ankit Agarwal, MD of Devika Group, notes here. But the big catch right up front is the minimum amount of investment required to get started. Understanding this initial buy-in threshold is critical because it dictates how accessible these vehicles are for your specific portfolio, even before we start talking about the daily mechanics of trading them.
And when we do compare those daily mechanics, the differences are night and day. Mutual funds offer incredible click-and-go flexibility. You can invest offline, online, or directly through a fund's website. They're highly liquid. REITs, they're strictly exchange-listed. To buy or sell a REIT, you have to transact exclusively through a demat account. So if you don't already trade stocks with an active demat account, that's an extra layer of friction you absolutely have to factor in.
Just to show you how liquid a mutual fund really is, check out this cash-out process. Step 1, you redeem your units online with a few simple clicks. Step 2, you just wait 2 to 3 business days. That's literally it. Step 3, the money deposits directly into your bank account. It is a highly fluid, effortless system that's designed to give you immediate peace of mind when you need your cash.
All right, Section 4, the tax angle. We are looking at Section 80C versus indexation.
1,50,000 rupees. If you're a mutual fund investor in India, this number right here is your best friend. Under Section 80C of the Income Tax Act, investors can be eligible for direct upfront tax benefits up to this maximum amount on specific mutual fund investments. It is a highly visible, incredibly popular weapon for keeping more of your hard-earned money out of the taxman's hands.
Putting these two distinct strategies side by side really highlights how differently they protect your wealth. Mutual funds give you those recognized direct tax-saving benefits under Section 80C. REITs, on the other hand, approach tax savings through something called indexation. Essentially, indexation protects your gains from being eaten alive by inflation over time, adjusting the purchase price to reflect current market realities. They both offer fantastic benefits, but they apply to entirely different phases of your investment journey.
But hold on, because REITs have a massive ace up their sleeve here. This is the ultimate trump card for real estate trusts: dividends. REITs typically pay out regular dividends, and by law, they are actually required to funnel at least 90% of their taxable amount directly back to you, the shareholder. For cash flow-focused investors who want passive income hitting their accounts regularly, that mandate is absolutely huge.
Even with those sweet dividends, Cern Goyal, a partner at RPS Group, offers a really important reality check on the overall tax burden. He points out that while both vehicles offer exemptions, the tax exemptions offered on real estate are comparatively lower than those of mutual funds. So mutual funds definitely take a slight edge when it comes to pure upfront tax-saving recognition. And finally, Section 5, making your choice. Let's get to the final verdict.
So, after weighing everything we've just discussed, who wins? Well, the truth is, there is no single objective winner here. The right choice for you completely depends on your individual investment goals, your personal risk tolerance for economic slowdowns versus market fluctuations, and your own preferences for liquidity and tax strategy. We're just here to equip you with the facts. And the facts say both of these are incredibly powerful tools, if they're matched correctly to your specific financial profile.
I want to leave you with this final thought to chew on today. Ask yourself honestly, what actually aligns best with your goals? Are you looking for the high liquidity and broad market diversification of a mutual fund? Or do you want direct exposure to massive physical assets and those mandatory cash-flowing dividends from a REIT? The choice is entirely yours to make. Thank you so much for joining me on this explainer, and as always, keep learning.